Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in. On this episode, we're going to be talking about appraisals. Stay tuned, you don't want to miss this. If you're watching this video on the Santo Sessa YouTube real estate channel, once again, thank you for watching. Thank you for all your wonderful comments. Don't forget to leave those below. And while you're down there, don't forget to hit the like, share, and subscribe button and that notification bell so you can get notified every time we post a new video. And if you want to book a consultation with myself or Santo, you can do that also in the description box below. But now, back to the video. Appraisals are an important part of the mortgage financing journey. Appraisals are important whether you're looking to purchase, refinance, or even switch to a different lender at renewal time to get a better interest rate. Chances are your lender will require a home evaluation or an appraisal to determine the value of what they're lending against. So appraisals are important for lenders and for consumers, and we'll get into that in just a little bit more. At the end of the video, we'll also be talking a little bit about current interest rates in this environment. Now, looking at appraisals and why they're important is because appraisals will give an insight to the lender on the value of the home. Now that sounds pretty straightforward, right? But the way appraisals work in comparison to market value are different. A lot of times clients may get the two confused. Market value, or what you're paying for the home, is what the market is determining. An appraisal can be significantly different. Now, a lot of times when you're going to purchase a home, comparables are an important tool in determining what you will offer on that home. And that is no different when an appraisal looks at the home and they look at the fit and finish. Is it a 3-bedroom and a 4-bedroom? Is it a finished basement and a non-finished basement? Does the home have updated kitchens and bathrooms? Does it have landscaping? All of these things work on a plus and minus equation for the actual appraisal company and the appraiser who's generating the report. Now, it's important to keep in mind that each lender has its own set of approved appraisers or an actual database of lenders and appraisers that are matched together. So it's very important to understand that each lender has its own specific guidelines on what they require the appraisal company or appraiser to complete. So what types of appraisals are there? Well, there's the physical appraisal where someone actually goes out to the property, gets out of their car, goes into the home, snaps some pictures, and sees the home itself in real time. And then there are things like a desktop or drive-by appraisal where the appraiser has to go through the actual process to drive by and just ensure that the home is where we say it is. And then ultimately, and what is actually very common in this marketplace, are what's called automated or internal appraisals or valuations. And that is basically a system-generated product by each lender where they pull the data and they get an automated approval. Now, with that actual particular system, it doesn't generate a value, it just gives us an accepted or declined. And if it is declined on an automated process, then we have to go through and order an actual physical appraisal. So there are differences in between them, and so are the costs. An automated appraisal with a lender can start anywhere from $99 all the way up to $1,000, depending if we need to rush that appraisal. Because it's very important to understand that the appraisal company can take some time in order for them to get out to the property, complete the appraisal, generate the report, and submit it back to the lender. For example, if you're purchasing a home with less than 20% down and you require mortgage default insurance, chances are you do not need to pay for that appraisal. Even if a physical appraisal is required, it is going to be covered by the insurer. So there's no cost to you to fork out the money for that appraisal if you're buying with less than 20% down. And that's because these insurance companies have automated systems like the banks to determine the valuation. And a lot of times the lenders will use these same programs for homes that, let's say, are being refinanced or you're switching because the home value might be a lot higher than the actual mortgage amount. And when these two loan to value amounts start to get very close together, keeping in mind that 20% equity has to stay in the home at all times, sometimes the lender may approve it automatically or it might need a physical appraisal. So there are different situations in which an appraisal may be required. And as I mentioned, there could be a desktop in there as well. So there's a lot of different components to understand. But why is an appraisal important to you, the consumer, especially in the purchasing process? If you're purchasing a home and you don't get an appraisal done within your 5-day window of financing, there could be some significant problems down the road. In this current market, with home prices on the decline, if you don't get that valuation closer to the time of purchase, you run the risk of that home not appraising. Now, obviously, this is a big problem depending on how much money you have to play with. You want to try to get that appraisal in within that 5-day conditional finance, because in that opportunity, or with that opportunity, you have the ability to A, walk away from the purchase if you see fit, or 2, you can actually continue with the purchase, but you will be prepared or have to prepare for yourself to give actually some more money either as a down payment or that compensate the difference to the seller, and that can change the amount of down payment and the amount of money you need to come up with. So there are some differences there. But ultimately in this market, you may have the possibility, if the appraisal value comes in lower, that you can go back to the negotiating table within the 5-day window and try to get the price reduced. So obviously there are important reasons why this appraisal should be done ASAP. And we have seen a lot of clients where we're picking up these deals from lenders or other brokers that they have not done this, and there's not much that can be done once that home is purchased. And if that appraisal value isn't supported, right, that client is now on the hook to close that after that conditional finance period. So making sure that you're working with someone who understands how time-sensitive appraisals are, which lenders require what appraisals, and ordering those appraisals right away is very, very important. We had a client in a very similar situation where we got the purchase in, they had a conditional 5-day window for financing. And the first thing we did is, because we weren't sure exactly if that lender was going to get it automated or it was going to require a physical appraisal, we ended up just submitting the request for the physical and then backed out of the physical once we found out that the lender was able to do it internally, because that particular company was extremely busy and wouldn't have been able to get it done if we even waited an extra day or two. So always understanding who you work with does matter, especially when it comes to purchases. And obviously with refinances, why an appraisal is important is because if you're asking for more of a loan in comparison to the value of the property, the lower the value of the property is, the less the loan can possibly be. So just some food for thought. Now, let's get into the interest rates. Now, let's talk a little bit about current interest rates right now, as that is an important conversation for many clients who are looking to go out there and maybe understand what is happening with renewals and refinances and purchases. So obviously we know that there's insured and insurable mortgages. What are those rates? Well, fixed rates are starting anywhere from 5.19% all the way up to 5.44%, and variable rates are starting at 5% all the way up to 5.50%. For switches and transfers, those are pretty much identical depending on the actual loan to value, how much money is in that property. And those are actually back-end insured deals where you don't have to pay the insurance premiums. And then there's your conventional 30-year refinances where the product is not insured, it's basically on the bank's balance sheets. So there is an additional premium added to those rates. As you can see, fixed rates start at 5.54% all the way up to 5.79%. And variables hovering around the 5.5 to 5.80%, which is a basic marginal discount anywhere from prime minus 15 to 40, 45, or 50. There are different ranges there. And then there's insurable rates for 1 to 4 years. Now, over the last little while, what we've seen is that with the inversion and the bond market being where it is right now, generally the 1 to 4 year, 1 to 3 year, and 5 year products are pretty much in line. Actually, some of the shorter term mortgages are actually more expensive right now. So making sure that you understand that. And we're seeing fixed rates for 1 to 3 year, 4 year products range from 5.64 to upwards of 6%. And you're also seeing these products in the switch and transfers. For a lot of clients right now, what they're trying to do is basically securitize a rate for the short-term window. And obviously the banks are aware of that. So if you're coming up for renewal, a lot of times people take a conventional 5-year product, but now with interest rates being elevated, a lot of clients might lean on a 1, 2, or 3 year product until interest rates may level off in the future. And then you have your conventional rates. These are for purchases that are obviously either 20% or more down on a 30-year amortization, not on a 25. And we're seeing those rates hovering from the 5.59 all the way up to 5.79 and above. And then you also have the switches and transfers or refinance products where you're restructuring, and they're in and around the same rate. And what we've done is included also the B lenders, where these are the equity lenders who look at properties and look at income and Obviously, different things, different scenarios, blemish credit, a little bit differently. Obviously, their rates are a little bit higher. They're starting around 6.19%, plus for a 1-year product, plus those fees. So it's important to understand what is being offered in the marketplace right now. And obviously, all the products that we're talking about here are all full frill mortgages. They're all prepayment privileges. They do not have bona fide sales clauses. They are pretty much the creme de la creme when you look at the options in comparison to making sure that you can refinance that product and you're not hand tied in it. Even if you're taking a variable, it's a 3-month penalty. You're not actually hand tied for a certain amount of time. We've had lots of clients reaching out to us with different products where they were actually blindsided when they tried to get out of that mortgage because they're not able to. They have what's called a bona fide sales clause. They have to sell the property. They can't refinance it. If you're online shopping for rates, make sure you understand those particular nuances when you're asking questions about the rates that you're being offered. And we'll leave the video here. We hope that everyone found it interesting. If you like the content that we're producing here at InTouch Mortgage Solutions on our Finance Friday episodes, please don't forget to hit that like, share, and subscribe button and that notification bell so we can get that content out to as many Canadians as possible. But until next week, thank you for watching, thank you for clicking, and have a great weekend.